Gold is trading at extreme volatility right now as I record this. We are seeing swings of $50 to $80 in a single session. Silver is moving even more aggressively, pushing through resistance levels that held for months. And by the time you are watching this, everything I'm about to tell you may have already accelerated beyond what anyone predicted. I'm going to show you exactly why this volatility is different from anything we have seen in the last decade. And at the end of this video, I will break down the 3 price levels that will determine whether gold goes to 6,000 or 8,000 in the coming months. But first, I need to take you through what happened in the last 72 hours, because the developments coming out of the Middle East right now have fundamentally changed how every major institution on the planet is calculating risk. Let me be direct with you. The footage I'm about to show you is not comfortable to watch, but you need to see it. Because what you are about to witness is not just a military event, it is the death of an assumption that has underpinned global security calculations for 40 years. The assumption that missile defense works. Watch this with me. I'm going to play it on screen. Watch the sky carefully. You can see the trajectory of the incoming missiles, multiple streaks descending at angles that seem impossible. Now watch what happens next. The defense systems fire, interceptors launch, and then nothing. The missiles reach their targets. What you just watched is advanced hypersonic missile technology penetrating one of the most sophisticated defense networks ever created. This was not a failure of equipment. This was not a lucky shot that slipped through. This was a systematic defeat of technology that cost billions of dollars to develop and deploy. And here is what should terrify every investor watching this. If the best defense systems on Earth cannot stop these missiles, then every single risk model that assumes regional conflicts stay contained just became obsolete. Every calculation that assumed American military superiority would prevent escalation just failed. Every prediction that assumed oil supply chains were protected just died on camera. Gold and silver are not going up because of speculation. They are going up because the world just changed and the market is scrambling to figure out what that change is worth. Let me give you some specific numbers because I want you to understand the scale of what we are dealing with. In the last 72 hours, we have seen gold move over $200 from its weekly low. That is not normal volatility. That is institutional repositioning happening in real time. When gold moves that fast, it means the big players are not waiting for confirmation. They are acting now because they believe waiting is more dangerous than moving. Silver has been even more dramatic. We saw silver jump nearly 8% in a single session. The last time silver moved that aggressively was during the banking crisis when Silicon Valley Bank collapsed. Before that, you have to go back to the pandemic panic of March 2020. What do those two events have in common with right now? They were both moments when the fundamental assumptions about how the world works broke down. SVB showed that banks were not as safe as everyone assumed. The pandemic showed that global supply chains were not as resilient as everyone assumed. And right now, we are watching something even more significant. We are watching the assumption that military technology can protect critical infrastructure die in real time. I have been covering precious metals for years. I have seen fear spikes. I have seen geopolitical premiums get priced in and fade away. I have seen rallies that looked unstoppable reverse in a single day. This is different. And I am going to spend this entire video showing you exactly why it is different and what it means for your gold and silver positions going forward. Before I go any further, let me tell you what this video will cover so you know exactly what is coming. First, I'm going to break down the defense system failures in detail, not the mainstream media version, the actual technical breakdown of what happened and why it matters. Second, I'm going to show you the cascade of events that followed. Oil infrastructure attacks, strategic asset destruction, regional allies being pulled into the conflict. Third, I'm going to explain the market mechanics. Why gold and silver specifically are the assets absorbing this fear, and what the technical charts are telling us about where prices go next. And finally, I am going to give you the 3 triggers I am watching that will determine whether this becomes the biggest precious metals rally of our lifetime or whether it fades like previous geopolitical events. If you are new to this channel, welcome to Finance Currency. This is where I break down the financial data that mainstream media either ignores or gets wrong. If you care about protecting your wealth, understanding what is really moving markets, and staying ahead of the crowd, hit that subscribe button right now. And turn on notifications because the situation is evolving by the hour, and I am going to be updating you as it develops. Now let me take you into the technical details of what just failed, because once you understand the mechanics of what happened, you will understand why the market is reacting the way it is. The defense systems that were tested and defeated are not old technology. They are not outdated systems from the Cold War that nobody expected to work. They are the most advanced interceptor networks ever deployed in a combat theater. Systems that cost billions of dollars. Systems that were supposed to represent the cutting edge of what human engineering could accomplish. And they failed. Not once, not twice, multiple times across multiple locations against multiple types of incoming threats. The footage I showed you at the beginning is just one piece of what happened. Let me walk you through the full sequence. The first system that failed was designed to intercept medium to long-range ballistic missiles. This system represents over a decade of development, billions in research funding, the most sophisticated tracking and targeting algorithms ever created. Here's how it is supposed to work. Radar systems detect an incoming missile launch, computers calculate the trajectory and predict where the missile will be at any given moment in its flight path. Interceptors launch and fly to that predicted point. The theory is that if you know where something will be, you can put something else in its path. The problem is that theory was built for missiles that fly predictable arcs. Traditional ballistic missiles go up, reach an apex, and come down in a curve that physics dictates they must follow. You can calculate that curve, you can predict that path, you can intercept it. What Iran just demonstrated is technology that breaks those rules. The missiles used in recent attacks do not fly predictable arcs. They maneuver. They change direction mid-flight. They adjust their trajectory based on what the defense systems are doing. A military analyst I follow put it perfectly. He said, trying to intercept these new missiles with traditional interceptor technology is like trying to catch a fly with chopsticks, while the fly is watching your hands and actively dodging. The math that defense systems rely on stops working when the target is making decisions. And here's the part that really matters for investors. These defense systems are not just protecting military bases. They are protecting oil infrastructure. They are protecting shipping lanes. They are protecting the entire economic foundation of the global energy market. If those defenses do not work, then that infrastructure is vulnerable. And if that infrastructure is vulnerable, then oil prices, shipping costs, and energy security are all suddenly uncertain in ways they have not been for decades. Let me give you specific numbers on the cost asymmetry, because this is what should keep every military strategist up at night, and what every investor needs to understand. A single advanced interceptor missile costs between $2 and $4 million. In the recent engagements, defense systems fired multiple interceptors at single incoming targets. Reports indicate 10, 12, sometimes 15 interceptors fired at a single missile trying to achieve a hit. Do the math. That is $20 to $60 million in interceptors fired at a single incoming threat, and they still missed. Now consider what those incoming missiles cost. Reports indicate the advanced missiles Iran use cost approximately $200,000 to $500,000 each. The smaller drones cost even less. Some estimates put kamikaze drone costs at $2,000 to $5,000 per unit. A $2,000 drone forcing a defense system to fire $40 million in interceptors. Even if the defense works, the attacker wins economically. When the defense fails, the attacker wins completely. This is the math that changes everything. For decades, the assumption has been that advanced military technology creates deterrence. The logic was that potential attackers would see the defensive capabilities and decide the cost of attacking was too high. They would be deterred not just by the threat of retaliation, but by the impossibility of success. What we just witnessed destroys that logic. The attack succeeded, the defenses failed, and the economics favor the attacker so dramatically that even failed attacks impose massive costs on the defender. Now let me connect this directly to gold and silver, because this is not abstract military theory. This is directly impacting what you own or what you are thinking about buying. When defense assumptions fail, risk models have to be rebuilt from the ground up. Every institution, every hedge fund, every sovereign wealth fund that had a model for Middle East risk exposure just watched that model become obsolete. And what happens when sophisticated investors suddenly realize their risk models are wrong? They do not sit and wait to build new models. They act immediately. They move into assets that do not depend on any model being correct. Assets that do not have counterparty risk, assets that have stored value across every crisis in human history. They buy gold, they buy silver, they buy the metals that have been money for 5,000 years and will still be money no matter what missiles can or cannot do. The volatility you are seeing in precious metals right now is not retail investors panicking. It is institutional money recognizing that the world changed and repositioning accordingly. I have seen this pattern before. In 2008, when the financial system revealed itself to be more fragile than anyone expected, gold went from 800 to 1,900 over the following 3 years. In 2020, when the pandemic showed that global systems could break down overnight, gold surged from 1,500 to 2,000 in months. Both of those were moments when core assumptions about how the world works proved wrong. Both triggered massive repricing in precious metals. What we are witnessing now is potentially larger than either of those, because this is not about one sector of the economy being fragile. This is not about a virus disrupting supply chains. This is about the fundamental assumption of military security, the assumption that underpins global trade, energy markets, and geopolitical stability being proven wrong on camera for the entire world to see. The people who understand what just happened are buying gold and silver right now. The people who do not understand yet will figure it out over the coming weeks and months. And by then, prices will be significantly higher. Let me show you what happened next, because the defense failures were just the beginning of a 72-hour period that rewrote everything. Within hours of the defense system failures becoming public, the situation escalated in multiple directions simultaneously. First, let me talk about what happened to strategic infrastructure, because this is where the economic impact becomes impossible to ignore. Reports confirmed strikes on radar installations that cost over $1 billion. These were not minor military assets. These were the eyes of regional defense, the systems that provide early warning of incoming attacks, the technology that gives defenders time to react. One installation was reportedly destroyed by a drone that cost less than a new laptop. $1 billion in advanced radar technology taken out by something that cost a few $1,000s. The asymmetry is so extreme it seems like it cannot be real. But the footage exists. The damage is confirmed, and every military planner on the planet is now recalculating what these economics mean for their own defensive postures. Second, there were direct attacks on energy infrastructure. I am not going to specify exact locations because the situation is fluid and details are still being confirmed. But what I can tell you is that oil facilities have been targeted, shipping has been disrupted, and the choke points that the entire global economy depends on are now actively contested in ways they have not been for decades. The Strait of Hormuz carries between 20 and 30% of the world's oil supply every single day. Tankers transit that narrow waterway constantly. The global economy literally runs on that strait staying open. Recent reports indicate direct attacks on vessels in or near the strait. Ships have been turned away. Maritime insurance rates have spiked. Companies are starting to calculate whether the risk of transit is worth the cost. If the strait becomes contested enough that shipping slows significantly, oil prices do not go up 10%. They go up 50%, 100%. The models for what happens when a fifth of the world's oil supply becomes uncertain are terrifying. And here is what connects all of this to gold and silver. Oil priced in dollars going higher means the dollar buys less. Every barrel of oil that costs more translates into higher prices for everything else. Transportation costs rise. Manufacturing costs rise. Food production costs rise. The inflation that central banks have been fighting for 2 years suddenly gets reinforcements that make everything they have dealt with look manageable by comparison. Gold is the historical hedge against exactly this scenario. When currencies buy less, gold buys more. When inflation accelerates, gold preserves purchasing power. When the world becomes uncertain, gold provides certainty. That is why you are seeing the price action you are seeing. That is why the volatility is so extreme. The market is trying to price in a scenario that could mean dramatically higher inflation, dramatically higher oil prices, and dramatically higher uncertainty for months or years. I need to pause here and say something important. What is happening in the Middle East right now is not an abstraction. Real people are dying. Civilians are living in fear. Service members from multiple countries are in danger every hour. I cover gold and silver because that is what this channel does, and that is how I can help you. But I never want anyone watching this to think I am celebrating what is happening. These events are tragic. The fact that they drive the price of the metals I cover does not make them good. It makes them important to understand so you can protect what you have built. If you are finding this breakdown valuable, take a second and hit subscribe. This channel, Finance Currency, is where I connect the dots that mainstream financial media misses. Hit the notification bell because I am going to be updating this situation as it develops. And share this video with someone who needs to see it. There are people in your life who have no idea what is happening and no plan for how to protect themselves. Help me reach them. Now let me continue with the escalation because what I have covered so far is only part of the story. The conflict is spreading beyond the original participants. There have been reports of attacks on diplomatic facilities in countries that were not directly involved. Protests have turned violent. Security forces have been overwhelmed. In at least one incident, security personnel reportedly opened fire on crowds, creating diplomatic crises that will take years to resolve. This pattern of spreading conflict is exactly what gold and silver price in fastest. Because when conflict spreads, the uncertainty multiplies. Each new front creates new variables. Each new participant creates new unpredictability. Risk models work when variables are known and bounded. You can model a conflict between two parties. You can estimate escalation scenarios. You can calculate probabilities. But when conflicts spread, when new actors enter, when the boundaries of the crisis keep expanding, those models break down. And when models break down, institutional investors do not try to build better models. They buy assets that do not require models. Gold does not require a model. It has been valuable for 5,000 years across every type of crisis. Silver does not require a model. It has industrial demand that persists regardless of geopolitics and monetary value that has survived every war in human history. The spreading nature of this conflict is one of the most bullish factors for precious metals that I have seen in my career. Now let me show you what is happening in the metals markets themselves, because the geopolitics I have described creates the fundamental case for gold and silver. But the technical setup is what tells us when and how that case translates into price movement. Gold has been building a base pattern for months. Every time it pushed toward resistance, sellers stepped in. Institutional shorts added positions. Paper contracts were dumped on the market to cap the price. And every time the buying pressure absorbed that selling and came back for more. What you are seeing right now is the exhaustion of selling pressure. Think of it like a boxing match. One fighter keeps throwing punches, the other fighter keeps absorbing them and staying on their feet. Eventually, the fighter throwing punches gets tired, their arms get heavy, their punches lose power, and then the other fighter, who has been absorbing everything, starts to advance. That is what is happening in gold right now. The sellers have thrown everything they have at resistance levels. They have shorted. They have dumped paper. They have used every technique that has capped gold rallies for 20 years. And it is not working anymore. The physical demand is too strong. Every dip gets bought. Every pullback finds new buyers. The supply is too tight. Mines cannot increase production quickly. Refiners are running at capacity. Central banks are buying instead of selling. When sellers exhaust their ammunition against buyers who never stop, there is only one direction price can go. Silver is even more explosive. And I need to explain why, because most people do not understand how small the silver market actually is. The entire above-ground silver market is worth less than what major tech companies make in a single quarter. The market capitalization of Apple is over $3 trillion. The entire investable silver market is maybe 30 to 50 billion, depending on how you count it. What this means is that relatively small amounts of concentrated buying can move silver prices dramatically. When a few $1 billion decides to move into silver, it does not get absorbed quietly. It moves the price by dollars per ounce, not cents. And right now, the buying is coming from everywhere. Safe haven demand from investors watching the geopolitical chaos. Industrial demand from solar panel manufacturers racing to meet energy independence goals. Industrial demand from military contractors building equipment as fast as they can. Central bank accumulation as countries diversify away from dollar reserves. Retail stacking from individuals who see what is happening and want to own something real. All of that buying is hitting a market that is tiny by financial market standards. And the supply cannot increase because you cannot open a new silver mine quickly. It takes a decade to bring new silver production online in peacetime. In a period of conflict and uncertainty, it is effectively impossible. Here's the technical pattern I am watching. Silver has been coiling in a tightening range for weeks. Each low has been higher than the previous low. Each high has been testing the same resistance zone. The price action looks like a spring being compressed. When springs release, they do not move gradually. They snap. The last time silver broke out of a compression pattern this tight was 2020. Silver went from 18 to 30 in a matter of weeks. Before that, the 2010 to 2011 breakout took silver from 18 to nearly 50. If silver breaks out with the same percentage move as 2020, we are looking at prices in the mid-100s. If it moves like 2011, we are looking at prices that would seem absurd to say out loud right now. And the catalyst this time is stronger than either 2020 or 2011. Those were primarily monetary events. Central banks printing money, currency debasement fears, important drivers, but limited in scope. What we have now is monetary pressure plus geopolitical crisis plus energy uncertainty plus supply constraints plus industrial demand surge. Every factor that can drive silver higher is aligning simultaneously. Now let me talk about something most people are not watching but should be. The premium that physical silver commands in Asian markets versus Western paper prices. Reports indicate that silver in China has been trading at significant premiums to Western spot prices. In some cases, physical silver in Shanghai has traded 20 to 30% higher than what the COMEX says silver is worth. That gap is not sustainable. Either Eastern prices have to come down or Western prices have to go up. Given everything I have shown you about demand dynamics, which direction do you think that gap closes? When that gap closes, and it will close, Western silver prices do not adjust gradually. They spike to meet the physical reality that Asian markets have already been pricing in. This is one of the most asymmetric opportunities I have seen in precious metals. The downside is limited because physical demand puts a floor under prices. The upside is dramatic because the market is tiny and the buying pressure is enormous. The volatility you are seeing right now is the market figuring this out. The big moves in both directions are institutional players repositioning. Some are taking profits from earlier buying, some are covering shorts, some are adding new positions. When the repositioning is done, and it will be done soon, the trend will emerge clearly. And based on everything I am seeing, that trend is up. Now let me give you what I promised at the beginning of this video. The 3 triggers that will determine whether this becomes the biggest precious metals rally of our lifetime. I'm not throwing out dramatic numbers for clicks. I'm telling you what the scenario analysis actually suggests when you take the current situation and project it forward. Trigger number 1, the energy choke points. If the Strait of Hormuz becomes significantly disrupted, oil does not go to 100. It goes to 150, 200, potentially higher. The models for sustained strait disruption are genuinely terrifying. What happens to gold in that scenario? Gold becomes the only hedge against an inflation spike that makes 2022 look like a warm-up. Central banks are paralyzed. Raising rates into an energy crisis causes depression. Cutting rates into inflation causes hyperinflation. There is no good move. Gold does not go up 20% in that scenario. It reprices entirely. The 6,000 to 8,000 range becomes realistic, not as a ceiling, but as a new baseline. I am watching tanker traffic data daily. I am watching insurance rates for Gulf shipping. I am watching every report on strait accessibility. The moment significant disruption is confirmed, I expect gold to gap higher immediately. Trigger number 2, military asset vulnerability. Major naval assets have been targeted in recent days. The same missile technology that defeated land-based defense systems can be deployed against ships. The economics are even more asymmetric at sea. A missile costing a few $100,000 versus a ship costing $10 billion or more. If a major naval asset is significantly damaged or destroyed, the American response will be total. Escalation becomes irreversible. The conflict that has been regional becomes global. Central banks around the world shift from record gold buying to emergency gold buying. I am not predicting this will happen. I am telling you that if it happens, the gold price you see today will look like a historic bargain in hindsight. Trigger number 3, conflict spread. What started in one region is already spreading. Diplomatic facilities have been attacked in countries not directly involved. Protests have turned violent across multiple continents. Security situations are deteriorating in places that were stable a week ago. If the conflict continues to spread, if new fronts open, if countries that were observers become participants, then every risk model that exists has to be thrown out and rebuilt. Gold thrives when models fail. Gold thrives when uncertainty becomes impossible to quantify. Gold thrives when the question stops being how much risk is there and starts being is there any safe asset left. If the conflict spreads significantly beyond its current boundaries, gold goes to levels that seem impossible today. Silver follows with leverage. Now let me tell you what I am doing and what I think you should consider. If you already own gold and silver, stay the course. Do not let volatility shake you out of positions that are correctly positioned for what is happening. There will be down days. There will be pullbacks. There will be moments when gold drops $80 and every headline screams that the rally is over. Those moments are noise. The structural drivers, the supply deficits, the central bank buying, the industrial demand, the geopolitical risk, none of that changes with a daily price swing. Trust what you own. Trust why you own it. If you have been on the sidelines, I am not going to tell you what to do. That is not my role. But I will tell you this. The technical levels that have capped gold and silver for months are breaking right now. Once they break cleanly, there is minimal resistance above. The path to new all-time highs is open. Every person who has been waiting for a pullback to buy may be learning the hardest lesson in markets. Sometimes the pullback does not come. Sometimes the breakout just goes, and you either got on before it left, or you watch it from the station. I am watching this situation around the clock. I am updating my analysis as new information comes in. If you are not subscribed to Finance Currency, you are missing the real-time updates that can make the difference between being positioned correctly and being late. Hit subscribe right now, turn on notifications. This is the most important macro environment for precious metals in at least a decade, possibly longer. You need to be plugged in. Drop a comment below. Tell me where you think gold goes this month. Tell me where silver goes. Tell me which of the 3 triggers you think fires first. I read every comment. I pin the best predictions. I want to know what you are seeing because sometimes the best insights come from this community. Share this video with someone who needs to see it. There are people in your life with savings sitting in assets that will get destroyed if any of the scenarios I described play out. They need to understand what is happening. They need to see the data. They need to make informed decisions about protecting themselves. You watching this video means you understand something most people do not. That understanding is valuable. Share it. This is Finance Currency. I will be back with updates as this situation develops. The volatility is not ending. The uncertainty is not resolving. The triggers I described are still active. Stay sharp, stay informed, and if you have not already, get positioned before the next move. Gold and silver are telling you something right now. The question is whether you are listening. I will see you in the next video.